begin today's conference. Thank you.
Morning, everyone. Thank you very much, Courtney. Welcome to the webinar focused on UK tax matters for professional services firms. My name, as already mentioned, is Anna Jarrells. I lead the professional services tax team in the UK. And for those who don't already know, BDO has got over 80,000 people around the world, and we operate in over 167 countries. But today, as I've mentioned, we will be focusing on UK tax matters, and there's plenty of those to be dealing with right now. We have a range of speakers to focus on a number of different areas, so I'll just list those out for you. Francis Edwards and Louis Keepin are both advisors in our professional services tax team. We also have Paul Wong, who specialises in giving research and development tax credits advice, and Simon Bird, who is well experienced in giving advice on the implementation of DAC6 complex matters, as I'm sure you're aware. So we would like to cover a number of different areas today, but as mentioned, please do raise your questions as we go through. We'll be covering specific matters coming out of C19, the budget, which feels like a long time ago now, the operation of DAC6, and also R&D credits, all of which are really important right now for us. But please continue to ask questions, as I say, but we'll first turn to the C19 matters. So along with the health crisis, C19 has brought us the financial crisis, which we're all grappling with right now, dealing with matters such as furlough, where people are based in the world, but also this financial crisis that we're looking to manage our businesses for going forward. Not least, we've ended up with people in our businesses in locations that we didn't actually expect them to be in. So our first part of our webinar today will be really looking at the issues that are facing us because of those restrictions. So Louis, if you could pick up on the first area, which is all to do with the implications of the restrictions of travelling due to C19, please.
Yeah, sure. Thanks, Anna. The potential tax issues arising from international travel restrictions are quite varied. We start with international staff. Managing international staff through the COVID-19 crisis is going to be increasingly demanding, as we know. In many cases, physical assignments just aren't going to happen. They might be delayed or postponed, and redundancies may also occur. The following important issues, I think, need to be considered. If assignees need to stay in the UK or come back to the UK because of the virus, they will need to consider the impact on their UK residence days under the statutory residence test. As well as tax residence issues, where individuals remain in a country as a result of COVID-19, it could also affect their eligibility for expat tax concessions, social security, withholding taxes on earnings, etc. Could trigger unexpected personal tax liabilities and could also potentially have an impact on the status of the employer. As we know, many staff with international roles would have returned home, so are working from a single location now. Cross-border commuter jobs may now be working remotely from their home jurisdiction. Yep. We expect that a number of countries will introduce concessions to their usual roles. For example, we understand that France may not insist on French social security employees have to remain there for an unexpected period of currently up to 60 days. However, without an official multi-country relaxation of tax and social security rules, I think there will be an impact for both the employee and the employer to manage. All jurisdictions will still expect all relevant tax returns and filings to be made. I think it's also vital that the employers have a strategy for dealing with their international employees and to ensure that all issues are thought through before final action is taken. I think otherwise, unintended consequences and costs may arise.
Yeah, and of course we're going to be in a position where lots of governments are looking for funding, so they're going to be looking for where they can pick tax up as opportunities arise for them. So will this also affect corporate residents and economic substance issues?
Yeah, I think that's kind of another side of the coin, really. The current travel restrictions obviously make it more complex for companies to manage their tax residents and also their economic substance position if they're reliant on directors travelling to meetings in other territories. I think if we take, for example, if board meetings have to be held in the UK or remotely, or the company is effectively controlled by directors in the UK, given the result of the travel restrictions arising from the crisis, in theory, it may affect whether or not the company is liable to UK corporation tax. I think also, in addition, if there's not sufficient staff in a particular location or jurisdiction, the business may not be able to prove that it has a sufficient economic substance in that jurisdiction. and the anti-avoidance legislation of other tax jurisdictions may also come into play. I think different jurisdictions may take different approaches during the COVID-19 crisis. If we look at Jersey as an example, it's already announced that it is relaxing its economic substance and residence rules during the crisis. I think we'd probably expect other jurisdictions to make short-term concessions in time, but currently the UK government has yet to make any comment on corporate residence issues or related tax rules. I think any business that may be affected by residence or economic substance issues should really seek expert advice on the circumstances.
Yeah. Excuse me, and the picture's changing all the time, isn't it? So there's also the personal issues around this, isn't there? So what about personal residency?
Yeah, that's a good point, I think. As we know, the rules for establishing whether or not individuals are tax resident in the UK, the statutory residence test has been brought in, as we know, depend amongst other factors on the number of days spent in the UK in a tax year. Non-UK resident individuals who end up spending more time in the UK than planned may find actually that they exceed the permitted number of days in the UK relevant to their circumstances. Usefully, up to 60 days spent in the UK can be ignored if they result from exceptional circumstances. And HMRC has issued guidance on this and how these rules apply to the COVID-19 crisis. UK tax residence has always been complex, and this just adds another layer of complexity. So there may be other issues to consider in determining an individual's personal tax status at the same time.
Yeah, and of course this might also make people think more about their life going forward as well. So there may be demands for people to be in different locations. So a lot of complexities around the commercial aspects of this as well as the tax matters. Okay, so cash is king in times like this, and there is a number of different deferrals that the government have outlined, and people have taken advantage, for example, of the VAT deferral already. But things on account of personal tax liabilities, big issues for partnerships. Francis, what's going on in this area?
So in relation to the deferral of the July income tax, when this measure was first announced, it was unclear who it applied to. The government had just mentioned the self-employed. It was later clarified that it would cover any July payment on account, regardless of the income source. It also seems that no interest will apply and no application is needed. Having said this, there is guidance that if the taxpayer can make the payment, they should continue to do so. There is no real clarity about what constitutes being unable to pay. Some HMRC commentary has used the word hardship. In the context of professional service firms, this can be even more complex if the firm retains tax and makes a payment on behalf of the partners. There's been no clarification on the definition of financial hardship and whether this is in relation to the firm as a whole or individual. However, as the tax liabilities belong to each individual partner, it would not be unreasonable for HMRC to consider the position on a partner-by-partner basis rather than considering the firm as a whole. The deferral puts more financial risk on the partners, as by deferring their tax payments, the tax reserve held on their behalf is being used for working capital within the business, and the tax liability still remains their personal liability. Some firms are therefore considering their constitution and who needs to agree the deferral, or if a separate discussion around the funding of the firm is required. Consideration is also required as to whether any deferral would be within the scope of the LLP agreement and the agreements in place in respect of the partner's tax reserve. We've also seen mixed messages from HMRC. BDO has been discussing the position with the policymakers who've been clear on the requirement to pay if you can, whereas we know that some of the customer compliance managers have been giving a different message that the deferral is more of a given. It's clear that it is just a deferral and the tax will still need to be paid in January 2021, if not in July.
Yeah, so storing up all sorts of cash flow matters, but just that consideration about whether it's paid or not, there's also a cultural matter for firms and how people feel within them. You know, the messages that you give to people about the security of the business and how people operate on a day-to-day basis. So a myriad of different things to think about. And I suspect we might see some more on this as time moves up to July. So as you say, Francis, that the money is going to have to be paid at some stage, and the question is whether that's by the firm, by the individual, and also at what time. So the time to pay arrangements, then people start thinking about if there's no natural deferrals, should they apply for a time to defer arrangement? But Louis, perhaps you could pick up on what might happen in this area.
Yeah, thanks, Anna. I guess the good news is the government have announced extra resources to assist those who are struggling to pay their tax liabilities and those who are in financial distress. And they've actually come out and said they'll be committing 2,000 experienced call handlers to support taxpayers, which hopefully should make it a bit easier for the taxpayer to get through to HMRC. This includes a dedicated COVID-19 helpline, which is directly set up to help those who are in need. The support, I think, is going to include agreeing a bespoke time to pay arrangement with HMRC. So this is designed to help those struggling with cash flow and allow those who enter into arrangements to spread the liabilities owed over a pre-agreed period with them. HMRC have also said they will waive late payment penalties and interest where people or businesses experience admin difficulties contacting HMRC or paying taxes due to COVID-19. As we know, historically and going forward, it's always important to get upfront agreement with HMRC before a payment deadline. There's also a commitment to suspend debt collection proceedings, which is a useful update from HMRC as well.
Yeah. I mean, it's clear that they're trying their best to try and to support people. There's a limit on their capacity. We know that because there's only a certain number of people that work at HMRC, and people are definitely being moved around from one department to another, as you say, to support the really key areas of focus at any one time. But I think what we've also been told by HMRC that they do expect the rules that or the easing rules that they've put in place to be applied appropriately. So, for example, I suspect we should see down the line some sort of questions within the corporate criminal offence position around furloughing and whether people have been properly dealt with under the furlough procedures. So, for example, you're not allowed to work while on furlough. So if there's businesses out there that have been asking people to do some work whilst on furlough, that might be something that we see being picked up in any reviews on corporate criminal offence reviews. So interesting times as we go through. So it's not the only area to think about around C19. There's obviously other things that are going on in the tax world. Francis, did you want to just pick up on one of the consultations that is going on at the moment?
Yeah, sure. In the budget, it was announced there's an intention to require large businesses to notify HMRC where they've taken an uncertain tax treatment. It's expected that this will come into force from April 2021, but it's currently just in the consultation phase, and therefore the details are not final. However, HMRC have made it clear that it will cover partnerships, LLPs, and companies. So at the moment, the suggestion is that it will apply to businesses with revenue over 200 million or a £2 billion balance sheet. They've given an indication that it will be aimed at things with a tax effect of £1 million or more. Interestingly, this would be more onerous on a partnership paying income tax at higher rates in comparison to a company paying corporation tax. With the potential implementation date from the next finance bill, it's also possible that decisions being made now could fall into the scope of the new rules, depending on the year end of the business. Yeah. Whilst it's clear there's lots of moving parts, there is a concern that with COVID-19, that HMRC will not have the full capacity to give it consideration before its implementation.
Yeah, and I think that's all very fair points. Okay, so that's probably enough for that for now. Let's move to the areas of the budget. But so Louis, just picking up on the budget, which actually, as I said before, just feels like a really long time ago now, but it was only a few months ago. What were the key matters that we should be reminding ourselves of coming out of the budget?
Yeah, I think you're right, Anna. It was actually on the 11th of March 2020 when he delivered the budget, and it does seem like such a long time ago, given that everything else that's happened. I think initially there was some good news for companies seeking to invest, and there were no major shocks from the Chancellor at that time. I think, as we expected, corporate tax rates were held at 19%, rather than decreasing to the previously announced rate of 17%. There was also, however, an increase from 2 to 3% in the structures and building allowance. Yeah,
okay. Well, that's, as you say, they continue to be good news. But digital services tax, and I know this is an area that starts becoming more and more complex, but do you see that affecting professional services firms?
Yeah, so this came into effect from 1st of April 2020. Our view is very much that it's likely to impact the large multinational enterprises, looking at those with revenue really arising from the provision of social media services, search engines, online marketplaces to UK users, I think. Namely, it's going to be a 2% tax on the revenues generated from these streams. Initially, I don't think it's likely to apply to professional service firms, but could become an international tax blueprint, I think, for firms if the thresholds are deemed to be lowered in the future.
Yeah, okay. And how does the changes in the budget affect how businesses might choose to structure, if they're either setting up their new structures or perhaps thinking about whether the current structure is appropriate for them?
I think it might change the thinking a little, to be honest. Firms operating through partnerships and LLPs are going to continue to benefit from a lower effective rate of tax on full annual profit extraction in comparison to companies. But what is interesting, actually, is the announcement of an increase in the research and development expenditure credit, which Paul's going to cover later on, from 12 to 13%. I think together with the ability of companies to retain these profits, contributes to actually looking at the difference in effective rates between the two structures.
Yeah, okay. And of course, the age-old, particularly if pension pots are declining in value perhaps now, how's the allowances position changed in the budget?
In terms of the pension allowance, I think, as we know, most people are allowed to pay up to $40,000 in their pension in 2020-21, known as the annual allowance. For the ultra-high earners who earn an adjusted income of over 240k, the annual allowance tapers by £1 for every £2 of income to a minimum now of £4,000 a year, which previously was $10,000. Taper threshold was increased from 150k to 240k in March's budget. I think it previously impacted a wide range of high earners, included doctors and senior medical professionals. So I think this is kind of a key change for those individuals. Pension contributions will receive full income tax relief. This effectively means it costs basic rate taxpayers 20%, while higher rate taxpayers 40% only need to pay £60 to save the £100. There has been much speculation, I think, that a flat rate of pension tax relief may be introduced in the future, but this, of course, is only speculation, and there's no concrete evidence currently this is on the government's agenda.
Yeah, there's probably quite a lot of things on the government agenda right now, but pensions just continues to be one of those areas of real complexity, doesn't it? So watch this space, I guess. Okay. Other areas to think about then. So there has been some confusion in the past about the filing of partnership returns. How's the budget helped that particular aspect?
It's actually been fairly useful, I think. So for those firms who operate through LLPs, HMRC have actually looked to provide certainty for the filing of partnership tax returns, and this was very much following the Inverclyde judgment last year. So it's going to apply to those who might have been questioning the validity of previous and open tax inquiries. So in summary, the Inverclyde ruling casts doubt on the way in which tax returns and inquiries into LLPs really should be treated in legislation. The announcement by the government that new legislation will be introduced has kind of put the position beyond doubt and is considered to be retroactive. So let's see if this is challenged and if the legislation is clear cut in the future. Yeah,
okay. Well, some helpful things. And then finally, before we move on to the area of reporting under DAC6, getting your crystal ball out, Louis, what do you think might happen because of the financial crisis that we're seeing ourselves in relation to the tax arena going forward?
Very, very difficult to say. Obviously, there's been some very generous offerings by the government in supporting businesses and indeed individuals in these difficult times. I guess we just don't know what changes will occur, but the deficit will need to be reduced in some way. And this may well be through an increase in taxes or various other implementations. I guess we know that the planned changes to IR35 and off-payroll labour supply has now been deferred until April 2021, and DAC6 may also be pushed back now. So I guess, we just don't know. There will be a number of changes, and I think updates that will need to be monitored in the coming years and how that impacts businesses and individuals as a whole. Yeah,
as you say, the likelihood is that every government around the world will be looking to make sure that they secure the tax that they feel is rightfully due to theirs. So all of the general anti-avoidance rules and the reporting requirements that we're seeing regularly now were likely to continue. So as you say, watch this space. Right, brilliant. Thank you very much, Louis. Okay, so moving to another area, DAC6, so reporting requirements under DAC6. I mean, my experience of talking to clients is that some are getting their heads around this, some are still really trying to understand what it all means. Simon, perhaps you can throw some light on this particular area for us.
Yeah, sure. Thanks, Anna. So yeah, hi everyone. I thought I'd spend just a little bit of time kind of recapping on what the DAC6 rules are. I don't propose to go into those in a lot of detail. Obviously, we've had the directive for a couple of years now, so hopefully there's some familiarity with the rules, but then really kind of talk about what it is that we're seeing businesses do to deal with those new reporting obligations. Particularly as up until this weekend, we're still in the case that it looked like reporting was going to be needed in the summer period, and now we've obviously got the EC proposal, which Louis mentioned as well, which we can kind of touch on the effect of that. So this slide is just really a brief overview and summary of the DAC6 rules, or the MDR. So what it's concerned with really is identifying what the EU see as reportable cross-border arrangements and asking advisors, or in some cases taxpayers, to disclose those arrangements much quicker than they would ordinarily have to the relevant tax authorities, so that those tax authorities can consider those arrangements and decide whether they like them or not. It's badged as targeting aggressive tax avoidance measures. I find that an interesting concept when you look at some of the hallmarks and what they describe as aggressive. So as a tax professional, I find it quite academically interesting to sort of see where my barometer is compared to where theirs is. But what I think we'll find as a result of the level that they've set the hallmarks at is that we'll have quite a lot of disclosures, certainly more than the EU or HMRC were expecting in the short term. So as I say, it's targeted at reportable cross-border arrangements. There's a few sort of terms in there. So what is a reportable cross-border arrangement? The cross-border element is where you have an arrangement that concerns one or more EU member state or an EU member state and a third country, and where those participants meet one of a number of conditions, which is primarily whether all participants are resident in the same jurisdiction or whether one of them has a PE or activity in another jurisdiction. So it's often the case that where you are dealing with cross-border arrangements, you'll find that that's made or met. The reportable element is really whether that arrangement meets one of the prescribed hallmarks within the directive and is in a covered tax. And so the covered taxes are pretty much every tax other than VAT, customs, excise duties, and certain social security contributions. I say the primary reporting obligation falls on what's known as an intermediary. They're often the advisors in respect to the transaction, and from a UK perspective, there can be two types of intermediaries. One that the UK is referring to as a promoter, the other as a service provider. And a promoter is someone who designs, markets, organises, makes available for implementation or manages the implementation of a reportable cross-border arrangement. And the service provider is anyone who just provides aid, assistance or advice with regards to that designing or marketing or organising of the transaction. So you could have a situation where you just provide a small amount of advice in respect to one part. That could be accounting, that could be legal, it could be various different things. It could be banks providing finance, and that might still make them an intermediary. Where there is no intermediary or the intermediary doesn't have to report, then the obligation does default to the taxpayer, and they will then have to make the report. So there's a point there for communication with clients as well to make sure that they're aware of their obligations. So the report will be made to local tax authorities, and then there'll be an automatic exchange of information between any relevant EU jurisdictions. And in terms of timing, as we've touched on, so the current law as it stands at the moment is that the first round of submissions for any transaction that's entered into from 25th of June 2018 onwards would need to be made by the 31st of August. And then the standard ongoing reporting of 30 days from the date when the trigger event happens would be from the 1st of July 2020. However, we have had that EC proposal over the weekend, and that's proposed a 3-month delay to those reporting deadlines. So the 30-day rolling reporting obligation would start from the 1st of October, and all transactions that have been entered into since June 2018 would need to be reported by the 30th of November under that proposal. It is still a proposal at this stage. It needs to be approved by the various member states, which, interestingly, because of Brexit, does not include the UK. So the UK will have to be following whatever the EU decides. But I think if it does come to a delay, which is the noise that we're hearing from, and talking to a number of colleagues throughout the EU, I think the UK would be quite delighted to follow suit in this instance. So that's a very, very quick. Sorry.
Just before you go on, just a quick question on that. I suppose there's 2 points, isn't there? There's one around the sort of desire for people to delay these things. So, every time that there is an extension of a deadline, it doesn't mean that there's not going to be something new for us to be focused on. So we've had IR35 being extended in terms of the deadline. We've had, as you say, the DAC6 potentially being extended in terms of the reporting of transactions since the 25th of June 18. But the longer this time frame goes on, the more transactions there are that we need to be thinking about, and the things start stacking up in terms of actions. So I guess we've got a number of clients that are quite keen to get on with this review and reporting arrangement. So I think there's the practical aspects of this, as well as the sort of the allowance to extend the deadline. But also there's a question around, you mentioned Brexit already, but there is a question around whether or not we're going to have to report at all. I know that some questions that we get is, does DAC6 just disappear because is the UK really part of the EU anymore? So do you want to just clarify that particular point?
Yeah, sure. So to have a cross-border arrangement, it needs to concern a member state, or more than one member state, or a member state and a third party. And for the period of the Brexit transition period, the UK is considered to be a member state. So a transaction between the UK and the US, for instance, would still fall within the scope of being a cross-border arrangement under DAC6. As for after the transition period, there's still some uncertainty there. I think it comes down to negotiations and how the EU and the UK look to implement things going forwards. But I would say that it's probably quite a politically difficult position for the UK to take if they wanted to say, we've been involved in developing these rules, designing these rules, we're now going to turn our back on, as I say, rules that design advisors to disclose aggressive tax avoidance schemes as they describe them. So I would be surprised if after the end of this year, the rules kind of fell away from a UK perspective, but there's still some uncertainty as to exactly what that would be come 1 January 2021.
Yeah, so don't hold your breath. I think that's what you're saying.
Yes, don't hold out in hope. And I suppose, given the time frames we're talking about, it doesn't give you any scope for not having to report all of the historic transactions, as you mentioned. Yeah. I mean, there's a whole exercise which we'll come on to in a second as well around, how many transactions have happened in the past 2 years, and when it comes to the reporting deadline, almost 2.5 years. They all need to be analysed, they all need to be captured, and they would still need to be reported, even if it's decided after the transition period that the rules wouldn't apply or would only apply in certain circumstances.
Great, thanks so much.
Okay, so I won't spend too long on these hallmarks. I just wanted to really put them up as a reminder of the type of things that are reportable from an EU MDR perspective. The main thing I just wanted to drag out here on this slide was obviously the point that there are some hallmarks that are subject to a main benefits test. So you might meet the hallmark, but you still have to have one of the main benefits of your arrangement to achieve a tax advantage, and that's those on this slide here. For those that are familiar with tax avoidance legislation in the UK, we've had a concept of a main purpose test for a number of years now across lots of different areas. And I think it's important to note that this is specifically different to that. This is a main benefit test. So what's the tax benefit of the transaction, not what's the purpose for entering into it. But certainly from my clients and talking to a number of people, these are ones that are less likely to be resulting in a reportable arrangement because of that main benefit test. But that's not to say that you wouldn't fall within some of these hallmarks, particularly some of the, for large multinational clients I deal with, a lot of the cross-border transactions, the C hallmarks.
Yep.
And then this slide is just, these are the ones that are not subject to the main benefits test. So no motive test, no benefit test, just if you meet these hallmarks, the transaction is reportable. And this is really where, as said earlier, the interesting dynamic between what they describe as aggressive avoidance. I don't necessarily see that in some of these hallmarks. So, for example, on the transfer pricing ones, E in particular, any use of a safe harbor or any use of something that means you don't have to apply full transfer pricing principles, that's just automatically within E1. There's no main benefit, there's no purpose element to that, and therefore that would lead to reportable arrangement. So that's really a very quick canter through the rules. There's obviously lots of detail and interesting points within there, and particularly when you expand that out to all EU member states, all 28 states having to implement these rules. And I guess the first point to note there is that the directive almost only operates as a minimum standard. It's up to each jurisdiction to bring in their own rules, and there's nothing to stop them going further, as we've seen in a number of cases. And that can be not just restricting the rules to cross-border transactions. Some territories have said they'll apply it to domestic transactions as well. In cases of Poland, they've added in additional hallmarks, which apply, I think, the same for Germany, where there are domestic transactions as well. They can expand the covered taxes, and they can also change the reporting deadlines. So one of the key challenges for, I guess, advisors and clients is really understanding how each territory has implemented the rules and how that differs from the directive. So what does that mean, I guess, for us as advisors, and how are advisors looking to really mitigate the risk of non-compliance under this DAC6 obligation? And what I've just tried to summarise here on the slide is the process that we see a lot of businesses going through for how they plan to tackle this. And ultimately, it comes down to a risk-based approach, identifying where the specific risk is for your assessment, for your business and your organisation, and then making sure that you put in place a robust risk management process to capture those arrangements, make sure they're being analysed and reported where necessary. So I'd say what we start with is really a risk assessment. You've got businesses looking at which particular services, which particular parts of their business are most likely to be dealing with reportable cross-border arrangements. Are there any that you can say that the risk is low and others that the risk is particularly high? As I mentioned earlier as well, there's two types of intermediary. There's a promoter and a service provider, and the obligations on those two are different in certain respects. So are you likely to be a promoter in respect of those cross-border arrangements, or is it more likely that you're just going to be a service provider, and how does that impact into your process? Just coming down the right-hand side, you've got a training and communication point. Who in your organisation needs to have a detailed understanding of the rules, who needs to just be aware of them and be able to flag transactions, and that really comes from your risk assessment. There's a point around clients and client engagements as well, where you are an intermediary, it's your obligation to make a report if you think that it's a reportable transaction, but ultimately you will be reporting information about a client. So having some kind of communication and understanding with the client is going to be important. Would want to avoid situations where a client finds out down the line that a transaction has been reported because an advisor thinks it is reportable without having had that communication. And there can be things within there as well in terms of your terms of business with clients. One of the hallmarks, for example, is around confidentiality. do your terms of business impose any sort of confidentiality on a client that might mean that you fall within the scope of that DAC6 hallmark. And then coming around the left-hand side, you're onto your analysis of the transactions. I think often there's a point there around the culture within your organisation. What approach do you want to take to these rules? Is it a case that you're going to be more conservative, particularly around sort of defining or interpreting the main benefits tests, or whether you fall within the hallmarks, or are you going to be more bullish and take a more aggressive position? That will be a cultural decision within an organisation that everyone needs to be aware of, so that when you're analysing transactions, you're being consistent in the way that you approach them. There's a point about recording and reporting. How are you going to do that? Who's going to be responsible for doing that within the organisation? Is it frontline client teams? Is it a central team that's going to take the responsibility because they have the detailed knowledge? When are you going to do that, and how are you going to link it to your existing client take-on processes? Is it something that will be done at the start when facts about a particular transaction might be limited? And if so, how are you going to make sure that you keep this front of mind as transactions change, as they naturally do, and make sure that the relevant analysis is done at the right time on the final transaction? And lastly, really, and this is where I suppose the defence comes in terms of HMRC, being able to demonstrate that process, have that robust process in place that you can monitor, you can review, you can check that transactions are being flagged, analysed, and a decision being made, will be what ultimately is the defence of professional services firms. If and when HMRC come knocking on the door and asking to see what your DAC6 process is. So having that documented, being able to evidence that, and particularly, I suppose, one of the real challenges is being able to prove a negative. How can you show that you've done all you can to identify all of the transactions, even when they aren't necessarily reportable? Does that mean that you have to capture every single arrangement, or is there a limit that you're going to, or a certain threshold that you're going to apply to it? Having that clearly documented and being able to evidence to anyone who's looking at that process will be really important as well.
Yeah, absolutely. Well, if there's nothing else on that side, I think we'll move on to the R&D world, moving from the challenges of reporting and analysing transactions, historic and current, to perhaps a bit of light relief or some welcome relief, where the HMRC are looking to support businesses investing in the future. So, Paul, perhaps you could take us through the R&D position.
Thanks, Anna. So, as you mentioned before, Anna, right now cash is king, and the R&D tax scheme is one of those schemes that are obviously helping companies manage their cash flow, and it's something that we're now seeing a lot more in the market, which I'll touch on later. Now, my slides won't revolve around, you'll be probably glad to hear, won't be revolving around the tax legislation of R&D. It's more the considerations that professional services companies should be thinking about at this time, and also actually a little bit more specific issues that we're seeing in the market, obviously due to the current events. So, one of the things that I've come across with professional services, especially partnerships and LLPs, is that they believe they cannot make an R&D claim because ultimately, in order to make an R&D claim, you have to be liable for UK corporation tax. Now, that doesn't mean LLPs are out of or cannot qualify, because as long as they have an incorporated member of the LLP. Now, there are obviously things to consider, but as you can see in those first few bullet points, that those are the type of claims, type of companies that we've come across and we've supported in making claims from the big four, other accounting practices, international law firms, architects is probably, and the engineering consultancies are a little bit more obvious areas of that will be doing R&D, but as you can see, these are the type of companies that sometimes can be structured as LLPs, and understanding their organization structure and the relationships between the LLP and, shall we say, the incorporated member is kind of critical to that. So what I always suggest to people is don't just throw it out. Obviously, it's worth exploring with special advisors to explore, make sure that you have determined whether there is an opportunity to make a claim or not. Now, going back to what Louis mentioned, the RDEC rate has gone up to 13%, which is a good sign for large companies. But don't forget, there's also the small and medium enterprise scheme as well, where the qualifying expenditure hasn't changed, but it still remains at 33% of the expenditure that you identify relating to R&D. Now, I won't go into too much detail of what is qualifying expenditure, but ultimately, most claims, or probably 99% of claims, the main proportion of qualifying expenditure is your staff costs, so always bear that in mind. Just going down to the next set of bullet points that I have there, it does revolve around the doing, and that's what qualifies for your R&D. So as the first point talks about, to understand that relationship between the LLP and the incorporated member, so if the staff are employed by this incorporated member, to understand that intercompany agreement is potentially where there could be an R&D claim or not, and it's definitely worth having that discussion. You'll notice a lot of these bullet points is not necessarily just about the doing of R&D, but it's actually those relationships that you have. So labor expenditure, so I mentioned staff, but your third-party costs can also contribute to your R&D claim as well. It's key to understand from the outset how that relationship is, both as a fact pattern, but also from the commercial legal aspect, because that's what HMRC would look for. So there are, shall we say, there are traits to justify bringing in to rationalise those costs being brought into your claim. However, we appreciate most contracts are not set up for R&D tax purposes. So I think it's always worth, before setting out a relationship, having that discussion to make sure you are optimizing your claims when it comes time to submit. The last 3 or 4 bullet points of this particular slide is trying to demonstrate the threshold is not as high as most people consider to be research and development. The actual criteria to qualify for R&D tends to meet general engineering development activity. So going back to your accounting practice and law firms, you might be thinking, how do they what of it that they do that qualifies for R&D? But you actually consider the back office software development. If anything, this time we're all working from home now. It's the actual the IT infrastructure is so key to making sure that we operate in a seamless way and still able to help our clients in that manner. Now you have to think about the development work that goes into that to suddenly support that number of people on servers, making sure it's security, making sure your ERP or CRM systems are stable and scalable. And this is all those elements, and then stitching it to your legacy systems. All this is complex work. My colleagues on this call will know that we're going through our own in-house kind of upgrading our systems as well, and it's taking over a year now. So if it was easy, we were already been done by now. So you can see there's obviously challenges there, and that brings us to the last point. Critically, to qualify for the R&D, is got to make sure there's that scientific or technological challenge. So even if you have a logistical or legal issue, if you can link it to technology, which most of the world we live in now is all about technology, there's that element of things to consider. So I guess what my bullet points there are trying to do is just make sure you're aware things for you to consider, and not just to park it if you think it's just because you're an LLP and you might not qualify.
Yeah, and actually, in reality, we've seen a number of claims, as you've mentioned, in the group of people in your first bullet point. Just to give people a bit of an idea of what the sort of questions that HMRC are raising, what have been the common themes that you've seen over the last 6 months? Yeah, absolutely.
You mentioned before, obviously HMRC resources have obviously been reallocated to more priorities right now. But the last 6 months, in fact, the last year, their biggest focus has been on software claims. Nearly every industry is doing software one way or another, and software claims are being, shall we say, not say targeted, but there's a lot more attention focused on it, especially because software is intangible. So having specialists who can actually articulate the challenges that your company is facing is actually pivotal, because obviously it wards away those questions being raised by HMRC, because they're seeing a lot of claims of very generic wording, your generic software jargon, algorithms, codes, security, reliability issues. But if you don't go into the underlying challenges, that's where the questions will arise. So it's always making sure you have people who understand your industry and understand the technology as well.
Yeah.
That's a good point.
Okay, thanks.
So I'll quickly move on to my second slide, and this is the slide that's just about issues that we're seeing right now in the current events. And You know, I've mentioned before the top bullet point is obviously about those intergroup kind of contractual arrangements. You know, what is that relationship between the captive staff entity and the LLP? If it seems to be like actually the staff entity is supporting the LLP and the LLP can be viewed as client, then there is a chance there is an R&D claim in there as well. So something definitely to consider. But critically, you know, understanding the commercial relationship and the actual day-to-day operations is important, because there's obviously fact patterns that we can extract to support whichever position that we fall upon. The next few bullet points is what we're seeing companies reach out to for recently, because obviously they want to access that cash as quick as possible. So accelerating your R&D claims is definitely something which is keeping me busy, but that's good. And I think it's something that obviously a lot of companies will be thinking about. Now, there's what we've also known is as companies start to maybe their projects start to stall. Now, obviously, there's wider commercial considerations, but if we tend to find if the staff are fully engaged in the process, you tend to maximize your claims as well. So rather than just putting them on the bench or making them do menial administration work, actually get them engaged in the R&D process tends to be helpful as well. And the last bullet point is something I just want to touch on quickly. We've talked about the future funds, you know, the coronavirus business interruption loan scheme, time to pay was touched on before as well. It's quite key to understand how these are short-term schemes that have been put into place. And I always advise all my clients to consider the implications, how it impacts the R&D claims, especially for the SME claims. Just because if, for example, you're an SME claim, obviously the benefit is up to 33%, but these schemes may interact with it to the point that your claims only fall under the large company scheme, so drop from 33% to about 13%. So definitely something to speak about and raise if you have any concerns on that side of things.
Yeah.
And my last slide is a very quick one. It's obviously about our credentials, but critically, what I always say to most of my clients is make sure you're getting advice from a team that has a mixture of both your engineers, software developers who can help qualify the projects and make sure that all areas that tend to be overlooked are actually can be brought into your claim. But also, subsequently to that, you should have obviously a team of tax specialists as well, because they're the ones who obviously will have to quantify the claim, and ultimately your R&D claim goes into your tax returns. So having tax specialists and engineers working together means you're actually getting the complete and holistic advice as well. So yeah, and that's it from me in terms of the R&D aspects. Those are the key things that we've seen in the market recently.
Right. Thank you very much, Paul. And I think the key thing is getting the right people talking to the right people in the businesses, so that actually the techies are talking to the techies rather than the techies trying to speak to the finance team or tax people. Brilliant. Okay, thank you very much. Now, moving nicely from technology areas of focus into the way that perhaps we might all be organising ourselves moving forward. So perhaps looking at the workplace of the future and the tax aspects that relate to that. Francis, do you want to just pick up on some of the areas on here? Francis, we can't hear you. I don't know if you've got your phone on mute.
Yes, apologies. So BDO published its Property Advisory Industry White Paper report in early March 2020. The opening line read, "The world of work has transformed, and with it the workplace itself." I think it's fair to say that since the beginning of March, professional service firms have seen a further transformation. And although this seems an extreme acceleration, I think it's probably a path that we were already on. I think if we were to summarise some of the biggest lessons we've learned over the last couple of months, it's flexibility. Certainly people have needed to implement different working patterns, juggle other responsibilities, interact with different forms of communication. But when we're thinking about the drivers of change in property requirements over the recent years, there's probably three core elements. Technology, we've seen a huge increase in the use of digital tools and connectivity in recent years. And in current circumstances, this has meant that even the most reluctant to change have embraced how to work remotely. Many firms have redirected things such as their travel budget into bolstering their technology. I think it's important to remember that if there's a possible difference in tax treatment, for example, if you have moved your travel budget into, which would have received a revenue deduction into IT, for example, it's possible that that will now attract capital allowances, and this could cause a delay in tax relief. The general consensus has been that technology was moving towards a reduced need for space, but in a post-COVID-19 world, even with home working, the requirement for social distancing will, at least in the short term, mean that space is still required. Having an energised workforce is key. We could debate for a long time what drives productivity in a workforce, but some do argue that workplace environment is important, citing Google, Facebook and Spotify as examples. Therefore, many firms spend time considering the location, the feel of their office space. Unfortunately, this is a bit less easy to influence where the workforce is working remotely. It'll be interesting to see the impact on supply and demand in key locations, which in recent years have obviously seen space at a premium. Navigating back to an office environment is fraught with pitfalls. Making assumptions can be unhelpful. Understand what people want and overlaying what the government guidelines are will be key to engaging and getting the most out of the workforce in coming months. This might require flexibility to meet the needs of different groups. Some may be keen to get back to the office, while others may not. Certainly one size will not fit all. Research from Savills prior to COVID-19 said that more than half of their respondents to What Workers Want Europe survey stated that they would prefer to spend the majority of their time at a designated desk, whereas only 18% would prefer to work from home. So we're seeing that some professional service firms are taking time to understand, gather data relating to the circumstances of their people. For example, how many people use public transport to get to work? How far do they have to travel? How many will struggle to return to the office until their children are back at school? For professional service firms, many have now proved that working from home is possible. Therefore, as we phase out of lockdown, they will be considering if there is merit in the cost of adapting an office space to allow for social distancing, or even seeing increased running costs such as cleaning when the property is not being used at full capacity might not be their particular choice. The government's message is to work from home if you can, and I can imagine that many will choose to continue to work from home for some time yet. Having said that, there will be a proportion of staff for whom getting back to the office is important. Juggling costs against the risk in sacrificing productivity gains could be harmful to the bottom line over the long term and also impact businesses' ability to keep and motivate its best people. Adapting the office to allow for office working is required, and capital allowances for any modifications should be considered, and some firms may want to wish to consider how to spread the costs equitably between partners. COVID-19 is possibly the biggest opportunity for professional service firms to reconsider and redesign the way they use property. Now really could be seen as a blank page to start again. Will a smaller desk-to-staff ratio be relevant? Will we even move to a purely flexible approach whereby only the most important face-to-face interactions are held in office environments? It would definitely be interesting to see how this evolves, but I'm sure there will be a few distinctive approaches as to how professional service firms use property going forward, and I'll be interested to see how they evolve.
Yeah, thanks very much, Frances. That's a big question for everybody, particularly those that are looking at their leases and new opportunities coming up. Do they need more space because of social distancing, or do they need less space because of the way that we are working, or do they just need different space? So lots of questions to deal with that links in with health and mental well-being as well. That's brought us to the end of the webinar, and just conscious of time. So thank you very much, Frances. So I will close there. I just want to say thank you very much for everybody to join us today and to all our speakers. Normally when we do these UK updates, at least we're all sat in the same room reading each other's body language and things like that. So really appreciate the effort from everybody to listen and also to present today. So thank you very much. If you do have any further questions, then please do send them to us. There's some details on the screen here. You can find us very easily if you'd like to get us, contact us on LinkedIn or through the email addresses on the screen. So again, thank you very much, and we will send both the slides and the recording very shortly. Thank you. Courtney, over to you.
Thank you for joining today's call. You may now disconnect your handsets. Hosts, please stay connected and await further instruction.